Let me ask you a question. If you purchase farmland on March 23rd, 2016 for about $10 million, how does the same land show up on your 2017 tax return supporting a charitable deduction of $115 million? That's a jump of more than $105 million in under 2 years. No oil discovery, no skyscraper development, no sudden gold rush, just clay. And in 2025, the United States Tax Court reduces that deduction to $175,000, which means $115 million of claim deduction disappeared. That's not an adjustment, that's collapse. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. On this channel, we review real U.S. tax court cases so we can see how tax law actually works. If you appreciate fact-based legal breakdown with real numbers of real cases, make sure to like this video and subscribe to our channel. Let's now walk through what happened. This video covers tax court decision in the case of North Donald LA Property LLC versus Commissioner of Internal Revenue decided on February 19, 2026. Jefferson Davis Parish, Louisiana. Rice fields, crawfish ponds, flat land, a lot of water. On March 23, 2016, approximately 3,324 acres was sold for approximately $3,000 per acre. Total $9,888,000. This was what court called an arm's length transaction. That simply means unrelated parties negotiated freely in the open market. No family discounts, no insider pricing, just normal business. The court stated, a recent arm's length sale of the subject property is the best evidence of the fair market value. Fair market value means what a willing buyer would pay a willing seller, neither under pressure in normal marketplace. At the time of purchase, a bank appraisal valued the property at approximately $3,000 per acre as well, total of about $10 million. Every real-world indicator pointed to one conclusion. This was farmland worth about $10 million. Fast forward 21 months. In December 2017, the property was owned by North Donald LA Investors LLC, a partnership. The partnership donated a conservation easement. A conservation easement is a permanent legal agreement that restricts how the land can be developed. For example, no commercial development or mining. In exchange, the tax law allows a charitable contribution deduction. How do we calculate the deduction? Using something called before and after method. You basically calculate what the land was worth before the restrictions, what it's worth after the restrictions, the difference is the deduction. On 2017 tax return, the partnership claimed $115 million. Compare that to $9.9 million just 21 months earlier. That implies an increase of over 1,000%. That's not ordinary appreciation. That's a completely new valuation theory. To support that number, the partnership hired a mining consultant and an appraiser. Instead of valuing the property as farmland, the appraisal treated it as future large-scale commercial clay mining operation. Now, here's where we introduce a technical term. The appraisal relied on what's called discounted cash flow model, often abbreviated as DCF. A discounted cash flow model works like this. Estimate how much money something might earn in the future, project those earnings over many years, then discount those future dollars back into today's dollars because money today is worth more than money 10 or 20 years from now. It's a legitimate valuation method when the future income is reasonably likely. In this case, the appraiser projected millions of tons of clay's extraction, royalty payments of about $4.50 per ton, long-term operations, successful permitting, and zoning approval. If all that happens exactly as projected, the numbers become very large. But the court wasn't evaluating what could happen under perfect conditions. It was evaluating what was reasonably probable as of December 2017. And the court wrote, Highest and best use must be reasonable, probable, not merely possible. And then it also wrote, speculation does not establish highest and best use. That is a legal filter. The property had a very high groundwater table. That means water sits close to the surface. Mining below the water table requires expensive water management and pumping. An expert testified that such mining would likely be economically impractical. Rice loves water. Open pit mining filled with groundwater, not ideal. The court looked at whether there was strong evidence that millions of tons of clay would actually be sold. Clay existed, but existence does not equal commercial demand at scale. The court was not convinced that large-scale mining was reasonably probable. The appraisal assumed permits and rezoning approvals would be granted. Permits government approvals required for certain land uses. Zoning controls what type of activities are allowed on land. The court emphasized that assumptions are not proof. It stated speculation does not establish highest and best use. When a judge repeats something, it matters. The court returned repeatedly to March 23, 2016 transaction, the sale of $9,888,000, and stated an arm's length sale of the subject property is the best evidence of fair market value. In simple terms, real money paid in a real transaction carries more weight than projections about the future. Ultimately, the court concluded, we find that mining was not the property's highest and best use, meaning it was still farmland, and once mining was rejected, the income model collapsed. The easement covered approximately 260 acres. The court determined that the easement reduced the land value by only $675 per acre, and that once multiplied ends up to approximately $175,000. That was the allowed deduction. Compare that to $115 million claimed. The difference is $115 million. That's basically 99% of the deduction eliminated. So for every $1,000 claimed, about $1.50 survived. The partnership also deducted approximately $1 million paid to promoters, $50,000 paid to a law firm, and court classified those as syndication costs. Syndication costs are expenses incurred to organize and market a partnership investment, and under tax law, those costs generally cannot be deducted. The court stated plainly, syndication costs are not deductible. Now let's talk consequences. If $115 million in deductions were disallowed, and if the tax rate was 37%, that adds of approximately $42 million in additional tax. Then the court imposed 40% gross valuation misstatement penalty. That penalty applies when a claimed value is more than double the correct value. So again, 40% times $42 million adds $17 million in penalties. So total exposure could be approximately nearly $60 million before interest. The IRS also sought 75% fraud penalty. Fraud requires clear proof of intentional wrongdoing. The court declined to impose fraud. So instead of $31 million fraud penalty, only the 40% penalty applied. Still significant. This case did not turn on whether clay existed. It turned on whether large-scale mining was reasonably probable as of December 2017. The court compared real $9.9 million sale in March 2016 versus projected $115 million valuation built on assumptions, and it chose the sale. As the court made clear, speculation does not establish highest and best use. The clay didn't change, the water didn't change, the assumptions changed. And when projections collide with evidence, evidence wins. I'm Alex Dvorkin, a certified public accountant in the state of California. On this channel, we review U.S. tax court cases so we can see how tax law actually works. If you found this video useful and informative, please give us a like. And if you value detailed breakdown like these cases, please subscribe. I'll see you in the next tax course case review.